Welcome back to Stock Predictor. Today's video is one of the most important ones I'll make all year, because we're talking about the stocks I will sell in 2026. This is not about panic, fear, or chasing headlines. This is about recognizing changing cycles, understanding when a great company becomes a poor investment, and knowing when holding on can actually hurt your long-term returns. Remember, selling is just as important as buying. And many investors lose money not because they buy bad stocks, but because they refuse to sell good ones at the wrong time. Let me be very clear from the start. These are not bad companies. Some of them are industry leaders. Some of them made early investors very rich. But markets move in cycles, valuations change, and growth expectations eventually slow down. In 2026, I'm focusing on capital preservation, realistic growth, and risk management. If a stock no longer fits that framework, I sell, no matter how popular it is. One of the first stocks I plan to sell in 2026 is Tesla. Tesla changed the auto industry forever, and there is no denying the innovation or the vision behind it. But by 2026, the biggest challenge for Tesla won't be technology, it will be competition and margins. Nearly every major automaker now produces electric vehicles, and many of them do it at scale with thinner margins but broader global distribution. As EVs become more common, they stop being a premium product and start becoming a commodity. That puts pressure on pricing and profitability. Another issue is valuation. Even after pullbacks, Tesla often trades at multiples that assume massive future growth. But growth slows as companies mature. By 2026, I expect Tesla to be treated more like a large auto and energy company rather than a disruptive startup. When expectations fall faster than fundamentals, stock prices suffer. I would rather lock in gains and redeploy capital into areas with better risk-reward setups. The next stock on my sell list is Netflix. Netflix was once the undisputed king of streaming, but the landscape has completely changed. By 2026, streaming is no longer a high-growth, blue ocean market. It's crowded, expensive, and highly competitive. Content costs continue to rise, subscriber growth is slowing in developed markets, and consumers are becoming more selective about how many services they keep. Netflix still makes great content, but the economics are tougher now. Maintaining growth requires massive spending, and that puts pressure on free cash flow. In addition, advertising-supported tiers help revenue, but they also change the company's identity and margins. When a company shifts from pure growth to optimization mode, investors must adjust expectations. In 2026, I don't see Netflix offering the kind of upside that justifies the long-term risk, so I sell. Another major name I plan to exit is Meta Platforms. Meta owns some of the most powerful social platforms in the world, but by 2026, growth saturation is a real concern. User growth is slowing, especially in core markets, and regulatory pressure continues to increase globally. Advertising remains the main revenue driver, but ad markets are cyclical and sensitive to economic slowdowns. The biggest issue for me is capital allocation. Massive investments into long-term virtual and augmented reality projects may pay off one day, but they also create uncertainty. Markets hate uncertainty. When a company spends tens of billions on projects with unclear timelines and returns, it becomes harder to justify premium valuations. By 2026, I prefer companies with clearer cash flow visibility and disciplined spending, which is why Meta exits my portfolio. Next on the list is PayPal. PayPal was once synonymous with online payments, but competition has exploded. Fintech is no longer niche. Banks, tech giants, and startups all offer seamless digital payment solutions. Margins are thinner, customer loyalty is weaker, and switching costs are lower than ever. Growth for PayPal has slowed significantly compared to its early years, and innovation has not kept pace with competitors. While the company still generates revenue, the stock no longer fits my growth criteria for 2026. When a company shifts from disruptor to defender, returns often compress. For me, that's a sell signal. Another stock I plan to sell is Intel. Intel was once the unquestioned leader in semiconductors, but execution issues and missed technological transitions have cost it dearly. By 2026, competition in chips is fierce, with faster innovation cycles and higher capital requirements. Catching up requires enormous investment, and even then, success is not guaranteed. Semiconductors are critical, but not all chip companies are equal. I prefer companies that lead innovation rather than chase it. Intel may recover, but recovery stories tie up capital for long periods with uncertain outcomes. In 2026, I prioritize efficiency and leadership, which is why I exit Intel. Now let's talk about a stock many investors are emotionally attached to: Disney. Disney owns some of the strongest intellectual property in the world, but execution matters as much as assets. Streaming pressures, high content costs, and changing consumer behavior have reshaped the entertainment industry. Theme parks remain strong, but they are capital-intensive and sensitive to economic cycles. By 2026, Disney faces the challenge of balancing nostalgia with innovation. If returns on content investment don't improve meaningfully, margins remain under pressure. I don't doubt Disney's brand strength, but I question whether the stock will outperform the broader market. For that reason, I sell and look elsewhere. One more category I reduce heavily in 2026 is overvalued speculative growth stocks with weak cash flow. These are companies that rely heavily on cheap capital and optimistic projections. When interest rates remain higher for longer, these stocks struggle. Markets become less forgiving, and narratives stop working. In 2026, fundamentals matter more than stories. Let me explain something very important. Selling a stock does not mean you were wrong to buy it. It means the situation has changed. Many investors confuse loyalty with strategy. The market does not reward loyalty. It rewards discipline. When risk increases and reward decreases, selling is a rational decision. On Stock Predictor, my goal is not to chase hype. My goal is to grow capital sustainably. In 2026, I'm rotating away from crowded trades, overstretched valuations, and companies facing structural challenges. I'm moving toward stronger balance sheets, real cash flow, and reasonable expectations. If you've made money in any of these stocks, congratulations. That's exactly why selling makes sense. Profits are only real when you take them. There is nothing wrong with stepping aside, waiting for better opportunities, or reallocating into sectors with stronger tailwinds. Remember, the biggest mistake investors make is falling in love with stocks. Stocks are tools, not trophies. You don't marry them, you use them to build wealth. And when they stop working for your strategy, you let them go. If this video helped you think differently about selling, hit the like button. If you want more long-term market strategy, valuation analysis, and honest investing discussions, subscribe to Stock Predictor. Let me know in the comments which stocks you plan to sell in 2026 and why. Until next time, stay disciplined, stay patient, and trade smart.